Nike is one of the most recognized consumer brands on the planet, yet right now its financial foundation is fracturing. This downward trending line chart measures the specific damage. Over the last 12 months, the stock has lost nearly a quarter of its total value, with a particularly steep 13% decline hitting right at the start of 2026. That rapid collapse stems directly from slumping retail sales and intense growing competition from rival athletic apparel brands chipping away at their market share. The mounting pressure ultimately forced a complete leadership reset, with Nike replacing its CEO in late 2024. When a global giant bleeds so quickly, retail investors naturally wonder if the core business is permanently damaged. But exactly as the stock slipped below $56 a share, Barclays Analysts stepped in with a major upgrade, moving Nike to an overweight rating. In finance, an overweight rating is an analyst's way of saying a stock is expected to perform better than the broader market. This bar chart compares that sub-$56 current price against Barclays' new $73 price target. That gap represents an implied 30% upside from its current position. To justify this highly contrarian call, the analysts pointed to a specific psychological threshold, peak skepticism. Wall Street isn't ignoring the recent bad news. Instead, they are actively betting that an environment of maximum fear is exactly what creates a lucrative buying opportunity. This U-shaped curve illustrates a fundamental bottom. It's where financial realities stabilize and cannot degrade further. Peak skepticism creates this floor. With investors expecting the worst, all bad news is already priced in. This reality prevents further panic selling. Nike specifically reached this floor through a series of newly disciplined financial actions initiated by the new CEO in late 2024. According to Barclays, those actions are now translating into tangible operational progress and early financial inflections that signal a coming reset. Identifying a fundamental bottom requires looking past the panic. It relies on objectively recognizing when a bleeding company has successfully applied a tourniquet to its balance sheet. Outside the company's control, severe macroeconomic headwinds still threaten Nike's recovery. The largest is a persistent slump in consumer sales across China. Adding to that pressure are the looming higher import tariffs that have dominated corporate boardrooms and earnings worries over recent quarters. Against those international threats, Nike is generating its own internal tailwinds. The company is seeing clear operational improvements within its core North American market. This animated diagram of the balance scale visualizes Barclays' core mathematical thesis. The analysts project that the aggressive growth of those North American improvements will physically outweigh the combined damage of the China and tariff concerns. Corporate turnarounds are rarely perfect across the board. They succeed when one localized, highly profitable strength becomes powerful enough to drag the rest of the global operations forward. Barclays is not an outlier in its optimism. Their $73 target aligns closely with the Visible Alpha consensus target of roughly $72. Visible Alpha is a financial data platform that aggregates predictions from multiple Wall Street analysts. This segmented chart visualizes the current ratings from the 14 analysts covering the stock. 8 brokers recommend buying Nike, 5 maintain neutral ratings, and exactly 1 advises selling. The ultimate real-world test for this bullish consensus is Nike's upcoming fiscal third-quarter earnings report. Investors will see the hard financial data on this turnaround strategy after the market closes on March 31st. By tracking operational discipline against market sentiment, we see how the stock market actually works. When the public reaches maximum pessimism, that peak skepticism often serves as a highly reliable indicator of a generational buying opportunity.